SSI, SSDI, and Social Security have seen some important updates that could directly affect your benefits. If you receive SSI, SSDI, or Social Security, this information is relevant to you because 2026 has brought some meaningful changes across all three programs. Millions of Americans are still unaware of how these updates may impact their monthly payments, their eligibility, and their financial planning. Whether you are already collecting benefits or planning to apply soon, understanding these changes matters. Are the SSI income limits shifting? What happened to SSDI work rules? And what does any of this mean for your Social Security check? We are going to answer these questions clearly and simply in plain English, no confusing government language, and no runaround. Everything is broken down step by step so you know exactly where you stand, what has changed, and what you should consider doing next. So let's get into it. First, let's understand what is actually happening. The Social Security Administration, or SSA, has implemented a series of updates in 2026 that affect three major benefit programs: Supplemental Security Income, known as SSI, Social Security Disability Insurance, known as SSDI, and regular Social Security retirement benefits. All three programs are seeing changes at the same time, and that is what makes this particular moment especially important for so many Americans who depend on these programs. Let's start with SSI because this program serves some of the people facing the greatest financial challenges. SSI is a needs-based program, meaning it does not depend on how long you worked or how much you contributed to Social Security. It is based on your current financial situation. For a long time, SSI rules have been quite rigid. One of the biggest frustrations for SSI recipients has always been the resource limits. Previously, if an SSI recipient had more than $2,000 in savings, their benefits could be cut off entirely. For couples, that limit was $3,000. In today's world, where a single unexpected medical bill or emergency repair can cost thousands of dollars, these limits essentially prevented people from building any meaningful financial cushion. There is some genuinely good news here. The SSA has made administrative updates in response to pressure from advocates, lawmakers, and families across the country. These updates bring more flexibility for SSI recipients around what counts against your resource limit and how certain types of income are treated. One significant update involves what is called in-kind support and maintenance. This is a concept that has caused a great deal of confusion and hardship for SSI recipients over the years. In-kind support refers to things like food or housing that someone else provides for you. Previously, if a family member helped pay for your groceries or let you live with them, the SSA would reduce your SSI benefit as a result. In other words, receiving family support came with a financial penalty. Under the updated rules, how in-kind support is treated has been streamlined. And in many cases, certain types of family assistance will no longer trigger those reductions the way they used to. This is a meaningful change for people who live with family or receive modest help from loved ones. On federal SSI payment rates following the 2026 Cost of Living Adjustment, or COLA, the maximum federal SSI benefit for an eligible individual is now $943 per month. For couples where both individuals qualify, that figure is $1,115 per month. These amounts are adjusted annually based on inflation. Now let's talk about SSDI, or Social Security Disability Insurance. This program works very differently from SSI. SSDI is an earned benefit, meaning you must have worked and paid Social Security taxes to qualify. The amount you receive is based on your earnings history, similar to regular Social Security retirement benefits. SSDI is for people who become unable to work due to a serious medical condition expected to last at least 12 months or result in death. For SSDI recipients, one of the most stressful aspects of the program has always been what happens if you try to return to work. Many people want to test their ability to work again, perhaps part-time or gradually. But the rules around working while on SSDI have historically been complicated and, for many people, frightening. The concern is always whether attempting to work could result in losing benefits or having to restart the entire application process. The SSA uses the concept of substantial gainful activity, or SGA, to determine whether someone is considered able to work. If you earn above the SGA limit, the SSA may conclude that you are no longer disabled under their definition, which can affect your SSDI eligibility. For 2026, the SGA limit for non-blind individuals has been updated to $1,220 per month. For individuals who are blind, the limit is $2,700 per month. These figures are important to know if you are on SSDI and considering returning to work. There is also a protection called the trial work period that many SSDI recipients are not fully aware of. The trial work period allows you to test your ability to work for up to 9 months, and those months do not need to be consecutive. They can be spread across a 5-year rolling period without affecting your SSDI benefits at all. During those trial work months, you continue to receive your full SSDI payment regardless of how much you earn. The threshold for what counts as a trial work month in 2026 has also been adjusted, and it is worth confirming the current figure directly with the SSA or through a benefits counselor who can review your specific situation. This matters because for people with disabilities, the ability to try returning to work is not just a financial question. It is a question of dignity and freedom, being able to test your capabilities without the fear that one productive month will unravel years of legitimately earned benefits. The updated rules around the trial work period and continuing disability reviews are intended to give people more breathing room, and that is a step in the right direction. Now let's move to regular Social Security retirement benefits, which is probably the program most familiar to the majority of viewers. If you are near retirement age or already collecting, here is what you need to understand about what has changed and how it affects your monthly check. The most widely known annual change to Social Security is the cost of living adjustment, or COLA. The 2026 COLA has already been applied to payments. This adjustment is based on inflation data, specifically the Consumer Price Index for urban wage earners and clerical workers, known as CPIW, which measures how much prices are rising for everyday goods and services. As a result of this adjustment, more than 70 million Americans receiving Social Security benefits are getting slightly higher monthly payments. The exact dollar increase varies based on your benefit level, but the overall goal is to give retirees a bit more purchasing power to manage ongoing costs in groceries, utilities, and healthcare. Something many people overlook when discussing Social Security changes is that while a COLA increase is welcome, other factors can quickly reduce the net benefit. The most significant one is Medicare Part B premiums. For most people on Medicare, the monthly Part B premium, which covers doctor visits and outpatient services, is automatically deducted from the Social Security check. If that premium increases at the same time as the Social Security payment, some or all of the COLA increase can be offset before the money even reaches your bank account. So when you receive your statement and see that your payment has gone up, it is worth also reviewing what is being deducted. The net amount hitting your account may be smaller than the headline figure suggests. There is a protection in place called the Hold Harmless provision, which states that your actual Social Security payment cannot decrease from 1 year to the next solely because of a Medicare Part B premium increase. If the premium increase would technically wipe out your entire COLA adjustment, the SSA limits how much of the premium is deducted to ensure you still receive at least as much as the prior year. This is an important protection, and most Social Security recipients are covered by it. However, if you are newly enrolling in Medicare, or if you have a higher income and pay an elevated Part B premium through what is called the Income-Related Monthly Adjustment Amount, or IRMA, the same protection may not apply to you in the same way. Understanding whether IRMA applies to your situation is something worth reviewing carefully, ideally with a Medicare counselor or Social Security benefit specialist. Let's also talk about something that affects people who are still working while collecting Social Security, specifically those who have not yet reached what is called their full retirement age, or FRA. This is an area where a number of people get caught off guard, and the financial consequences can be significant. The SSA uses what is called an earnings test. If you are collecting Social Security retirement benefits before your full retirement age and you are still working, there is a limit on how much you can earn before the SSA begins temporarily withholding a portion of your benefits. For 2026, that earnings limit has been updated, and knowing this number is essential if you are in this situation. Exceeding the limit does not mean those benefits are lost forever. The SSA does credit them back to you later, but in the short term, it can result in reduced monthly payments that create real financial pressure. Once you reach your full retirement age, the earnings test disappears entirely. You can earn as much as you want from work with no reduction in your Social Security benefit. But for people who claimed early, and early claiming is very common with many people starting benefits at 62, the earnings test is a real consideration. If you are working and collecting early Social Security, you need to understand this limit and factor it into your planning. On the topic of when to claim Social Security, this is one of the most consequential financial decisions a retiree will ever make. The rules have not changed dramatically, but given everything happening across the system right now, it is worth revisiting the basics because many people make this decision without fully understanding the long-term implications. You can begin claiming Social Security retirement benefits as early as age 62. However, claiming at 62 means your benefit is permanently reduced, typically by around 25 to 30% compared to what you would receive at your full retirement age. Your full retirement age depends on your birth year. For those born between 1943 and 1954, the FRA is 66. For those born in 1960 or later, it is 67. For people born in the years between, it phases in between 66 and 67. On the other end, if you delay claiming beyond your full retirement age, your benefit grows by approximately 8% for each additional year you wait, up until age 70. After 70, there is no further increase for waiting. So the range looks like this. Claim at 62 and receive a reduced benefit for life. Claim at your full retirement age and receive your standard benefit, or delay up to 70 and receive a significantly higher benefit for the rest of your life. The right choice depends entirely on your personal situation, including your health, finances, your spouse's benefits, and how you weigh short-term income needs against long-term security. There is no single right answer, but there are many costly mistakes that come from not understanding the trade-offs. Let's also cover something that often gets overlooked in Social Security discussions: spousal and survivor benefits. These are especially important for older women who may have spent significant portions of their lives as caregivers rather than in the paid workforce, and who may have lower personal earnings records as a result. If you are married, you may be entitled to a spousal benefit based on your spouse's earnings record, up to 50% of their full retirement age benefit if that amount is higher than what you would receive on your own record. You do not need decades of personal work history to qualify. What matters is your spouse's work history. And if your spouse passes away, you may be entitled to a survivor benefit of up to 100% of what your spouse was receiving. This is one of the most valuable protections in the entire Social Security system. Yet many widows and widowers either do not claim it correctly or do not fully understand the rules surrounding it. The timing of when you claim survivor benefits relative to your own retirement benefits can make a substantial difference in your total lifetime income. This is another area where personalized guidance, whether from the SSA directly or from an independent benefits counselor, can genuinely pay off. For divorced individuals, there are also rules that may allow you to claim benefits based on your former spouse's record, even if they have remarried. The general requirement is that the marriage lasted at least 10 years and that you are currently unmarried. If those conditions are met, you may be entitled to spousal or survivor benefits based on your ex-spouse's record, with no impact on what they receive. Many divorced seniors, particularly women, are unaware this benefit exists and end up leaving significant money unclaimed. One more important topic to address is protecting yourself from Social Security scams. These scams are widespread and becoming more sophisticated every year. Scammers will call, email, or text you while pretending to be from the SSA. They may claim your Social Security number has been suspended, that there is a problem with your benefits, that you owe money, or that you need to verify your personal information. The real SSA does not operate this way. The SSA will never call you unexpectedly to demand payment or threaten you with arrest. They will never ask you to pay using gift cards or wire transfers. If you receive a suspicious message claiming to be from Social Security, do not engage with it. hang up the phone or delete the email. If you are genuinely concerned, contact the SSA directly using their official contact information. Staying safe from scams is just as important as understanding your benefits because fraudsters specifically target seniors and people who depend on these programs. To wrap up, here is what to take away from everything covered today. The Social Security system, with all its imperfections, represents years of contributions from you and from the generations before you. The 2026 updates are part of an ongoing effort to modernize and adjust a program that touches more American lives than almost anything else the federal government administers. Some of these changes bring real improvements. More flexibility for SSI recipients, updated SGA limits for SSDI, COLA adjustments for retirees. Some broader policy conversations carry more uncertainty and deserve continued attention. But through all of it, the most important thing you can do is stay informed, stay engaged, and make sure you are claiming everything you have legitimately earned. You worked for these benefits. You contributed to this system for years, possibly for decades. You have every right to receive what you are owed and every right to expect the system to work as it should. Do not let confusion or uncertainty prevent you from accessing what is yours. Reach out to the SSA. Connect with a benefits counselor, speak with a trusted financial advisor, and keep following content that cuts through the noise and gives you clear, accurate information to help you make sound decisions for yourself and your family. The updates that have taken effect in 2026 are part of what is shaping up to be a significant period of change for these programs. We will keep watching, keep reporting, and keep breaking it all down in plain, straightforward language, because that is what you deserve. Your retirement, your financial security, and your peace of mind matter. Subscribe to this channel for more helpful updates and information.